I've been buying apartments for 35 years. We have a little over 10,000 apartments, 300 employees, and we're vertically integrated. I'm going to go over the top 21 mistakes that most real estate investors make. And these mistakes cost them tons of money and time. Number one, the market is more important than the property. Now, I talk about this in my first book, The ABCs of Real Estate Investing, and I can't emphasize this enough. You can make a poor purchase in a great market and do really well because the market is going to save you. But if you buy a really nice property in a bad market, it can go the opposite way. So a lot of people, they fall in love with the property and then emotionally sell themselves on the market when you really need to fall in love with the market and then go look for the property. The next one is that they treat it like a stock. So they want, like, if they're buying a house, to appreciate like a stock, like it goes up and down like a stock market. It does not. Most people are in the stock market, and that's why. So you have to treat the real estate investment like a business. It is a business, and buying a stock is not a business, but this is a very complex business. So you either buy it for cash flow or capital gains, and most people don't know the difference. They think they can just buy it and be transactional and kind of time the market. And that's the second mistake that people make. The next one is most deals are done on the back of a napkin. So what I mean by that is the numbers make sense from the beginning. So you got your rent, your expenses, your mortgage, and your cash flow. Pretty basic. And we always have the saying that the bigger the brochure, the worse the deal. In other words, if you have to sell somebody on a project, it's probably not a very good project. Most deals that I've done that have done really well have been super simple, easy to understand, and they generate a lot of interest early. And the business plan is a formality. It basically just puts all the things together that the property is going to do. Typically, most of the money's raised before the business plan is even put together. Most people think that they need the money before they start. This could not be further from the truth. I think most people use that as an excuse not to move forward. But the reality is all investors, every single person wants a deal, not the money. So you got to find the deal and then put together the money. And what most people think is, I got to have a savings, I got to have somebody that will fund this. That's not true. You just have to have an idea or a business or the deal itself, something that people can wrap their head around and something that you can discuss. So find the deal and then raise the money. The next one is people forget that real estate is local. In other words, it's not national. And so sometimes they use these national statistics or statewide statistics that are meaningless. Real estate deals are by neighborhood. They're by submarket. A street can be very different on each side of it. You can have a very rough area and a very nice area literally across the street from each other. So real estate is a very local business, and it's something that you need to understand if you're buying in a city or a town. You have to understand the little nuances that go on from block to block. So the deal we just bought outside of Las Vegas in Green Valley, the reason we bought it, one of the reasons, is because the area was supported by very expensive homes. It also had a Whole Foods, a Lululemon. All those were within walking distance of the property. The only reason I bring that up is if you're planting Whole Foods all around the country, you're looking for a very expensive demographic. You're looking for people that can afford to shop at Whole Foods. And so you can almost be assured that that area is going to be a little bit affluent. So when you find a property in a market like that and it cash flows, it's typically better than maybe a market that does not have that. So the next big mistake is a lot of investors try to do it themselves. In other words, they don't have a team. They like to work alone. They're a one-man band or whatever you want to call it. They're out there on their own, doing all the research on their own, and they're not utilizing the amazing resources of people that are in the market to get more and more data to make the deal even better. These people have no team and they have no leverage, they have no consultants, and they have no relationship. You got to be careful with these types of investors because in real estate investing, it really does take a village. It takes the experience and a wisdom from many people to be able to vet out a deal correctly. So if you want to see a due diligence checklist that you can see before buying any property, just click the link below. The next big problem is they track very basic research. So let's say maybe they listen to a realtor who doesn't really understand what's going on in a market, or they get some big data somewhere that actually doesn't make sense in that local market. So in other words, they're not very thorough. They're not asking the right questions. When I'm buying real estate, I'm always trying to talk myself out of it. What happens in a lot of cases for especially new investors, they're always trying to talk themselves into it. They're always trying to talk other people into it. I'm always trying to talk myself out of it first, and then only then, after I talk to a lot of people that verify what I'm seeing is accurate, then and only then do we go out and raise money for it. The next one is that most real estate investors don't understand the assumptions. Now, they might be good at math. In other words, they could take the math from a seller and put it into a spreadsheet and take a look at it, but they don't understand the assumptions behind that. They don't understand how to dig deeper and actually ask the right questions. In order to be a great real estate investor, you have to be able to challenge those assumptions. Assumptions like rent growth, assumptions like vacancy rates, assumptions like bad debt, assumptions like other income, assumptions like the increase in utilities or payroll or property tax or insurance, or all those things are very, very, very important. If you don't understand what questions to ask and what assumptions to challenge, then your numbers are literally just going to be math in a spreadsheet from the seller of the property, which of course means nothing, So I have a great example of this. Ross and I decided to sell a property that we had in Houston, Texas. And what we decided to do was renovate 4 units first to see if we could push the rents in those units. And after spending about $10,000 per unit, we were not able to raise the rents. In other words, the property and the area kind of had told us what the market could bear. And so you have to pay attention to that stuff. So sometimes you can over-improve a property and you'll never get the rent for it. So we decided, because this property had potentially capped, we would list it. And so we listed it to another group. It ended up going into contract. I happened to be on that group's email list. So you can imagine I'm the seller, but I also got the business package from the people that were trying to buy it from us. And in the package, now keep in mind, this is a property that I own. In the package, it had all kinds of assumptions and all kinds of projections based on what they thought the property was going to do. And of course, I knew better because I was the current owner. You can have an opinion about anything that you want. You can put any numbers that you want. You can put any assumptions that you want in any spreadsheet or any business plan at any time. The key is, of course, to trust but verify the numbers. And if you don't know what to ask, then you can't challenge the assumptions. The next one is they think speculating is investing. In other words, I know of people that are buying vacant land and trying to flip it, as an example. That is not a cash flow deal. That is not real estate investing. That's speculating. That's buying something low and hoping to sell it high. That is gambling. So you need to know the difference between speculation and investing. It's very, very different. And a lot of people that call them real estate investors are actually real estate speculators. They're trying to buy something and spin it out for more money. And I get this. I get the fact that there's a lot of equity and there's a lot of money to be made. But that is not real estate investing. That is treating real estate like a stock. That is treating real estate like a transaction that's going to go up later. What's crushing a lot of real estate investors today is that they're speculating on all the wrong things. And then, of course, interest rates went up and it crushed their deals. A lot of real estate investors overpay. In other words, they get emotional in the deal. They get invested financially. They get invested emotionally after they find something. Maybe they've been working a long time trying to find something and they're fatigued. And so they just want to get something in escrow. And then when they realize that maybe it's not exactly what they thought it was going to be, they just keep selling through it. In other words, they're a little bit delusional because they spent all that time getting to that point. And so what they do is they continue to sell themselves on the deal itself. They start to alter the data and they start to sell themselves on the deal itself. When, as we all know, it just boils down to straight math. The deal is what it is. No matter whatever price you pay, it's going to produce whenever the market allows after you buy it. What happens is a lot of people get to that point and they start to cloud their judgment as they start to move forward and buy these properties. Eventually they realize that sometimes it doesn't produce the way that they thought it was going to be, and it's all a result of them not doing their research. The next one is that they don't understand property management. So this is the big one that's going on right now with a lot of the syndicators. So they think it's a transaction. So they buy in these towns and they don't understand the nuances of a town. So let me give you a couple examples. One, if you buy in a college town, you're probably going to have 100% turnover. If you buy in a town that's full of seniors, you're probably going to have 30 or 40%. There's a significant difference in costs of expenses between those two things. So just understanding the differences of how to buy and operate a property that's, say, in a college town versus a senior town is significant. Yet a lot of times the numbers might look the same in a spreadsheet. They might be buying a property based on how it's running, let's say in a senior community, but it's really in a college town. And they're not going to hit their projections because there's a lot of things that go on in that kind of demographic. So understanding property management and all the nuances of property management as far as turnover, occupancy, expense, and all of the things that are around marketing and insurance and all of the things that are required to run a property like that are very, very, very important. So I see this a lot of times with syndicators just decide to go buy something and then they're now in that learning mode after they buy it. The best operators are the ones that understand the markets and the property management and how to run a building before they purchase it. And what we're seeing today is a lot of syndicators just went out and raised a bunch of money and they're figuring it out on the fly. The next one is a lot of people are buying negative cash flow deals. And this is my biggest one because I don't understand why people would buy something that has negative cash flow. Now, I do understand buying things that maybe are broken in the beginning, but if you could just bring the occupancy up, let's say, it should positively cash flow. But a lot of people bought negative cash flow deals from the beginning. You do not want to step into somebody else's shoes. I call this catching a falling knife because it could fall further. And if it falls further, then you're just going to continue to fund this deal. So a tremendous amount of people over the last several years bought deals that negatively cash flowed. In other words, they had a reserve of cash and they were funding it, hoping that the property would rise from a capital gains and it would be worth more money later. Well, with higher interest rates and higher vacancy and all the things that are happening, they ran out of cash and now they're in huge trouble. So I can't tell you how many calls I get of people that say, should I keep funding this deal or should I just sell it right now? And my question is, are you going to write a check or are you going to get some equity? And if they get some equity, I say sell it because you do not invest in real estate unless there's cash flow. And of course, the cherry on top is the capital gain or the appreciation, but invest for cash flow first and then capital gain second. The next one is many times investors focus on the deal as opposed to the operator. So what I'm always focusing on is the operator itself. So I want to find operators that are either doing a really good job or operators that are doing a really bad job because they're going to repeat the mistakes over and over and over. So years ago, I bought a big property in San Antonio, Texas, and it was 50% occupied. It was owned by the bank, and they had lent this group a bunch of money. So my immediate strategy was to find out from the bank who else lent this guy money and where else did he buy? Because what I wanted to do was I wanted to follow around the operator. So I went, he had his own management company. I just followed that around and I looked for the other properties that they were managing. And those are the properties that I started to pick off after that. Because all great deals start with really bad property manager and really bad operators. So sometimes you can find a deal that way. One great strategy is to look for the operator first. Another big mistake is the out-of-state landlord. So I see this all the time where people are like, oh, I bought a property in Memphis, Tennessee, or I bought a property in New Orleans, and you know, they live in Canada. Well, I'm not saying that can always be bad, but there's always issues with move-outs and tenant issues and with move-outs and vacancies and tenant issues. And of course, sometimes property gets damaged. And so you're getting on a plane and flying somewhere, you're renting a car, you're taking time and all that kind of stuff. Meanwhile, you're trying to figure out, how do I get great property management in the area, which is another big issue I keep hearing. where they can't find a great property manager. And of course, the property manager's doing their best, or maybe they're not. In most cases, unless you're a very professional, serious real estate investor, you should buy local. You should not be investing outside of your area. So I find that one of the biggest mistakes people make is this out-of-state landlord concept. Typically, that's for the person that's just throwing money around, trying to get passive income in some other place. Another one that I've seen is people buy unseen. Now, I know this sounds bizarre, but I've heard it. People actually buy real estate unseen. So one of the very basic questions you should ask is, have you been to the property? Because sometimes they'll take something from someone else, repackage it, and get investors for it and buy it, and the whole thing's turnkey. That's a mistake. You obviously want to visit every single property and vet all the information of every single deal that you're investing in. So hopefully maybe at some point you guys will get to the point where you actually have a team that can help you do this. But under no circumstances should you buy anything sight unseen. It should be either you or the team. Another big mistake is that a lot of investors invest solely on appreciation. In other words, they're like, last year it appreciated by 5%. Next year it's going to appreciate 5%. And the next year it's going to appreciate 5%. And the next year it's going to appreciate 5%. Well, don't we wish? That would have been 20%. So what happens a lot of times is people looking in the rearview mirror, and sometimes they've had a really good track record, but maybe it's you that are buying at the peak. You can't always say it's going to be 5% appreciation in the following year. And this is a huge mistake I see investors make all the time, especially when they're raising money. There's no way that you can predict or project what appreciation is going to be over the next 2 or 3 years. But I find this is a huge mistake for a lot of investors, specifically first-time investors. The entire deal is predicated on whatever they're buying is going up later. The next big mistake is a lot of investors use too much leverage. In other words, they're barely cash flowing. And if there's one small problem, like somebody moves out, or there's a bill for a new roof or whatever, all of a sudden they're in trouble. And what you want to make sure of is when you're putting leverage on, that you're using the right leverage. So there's short-term debt and there's long-term debt, and they're used for very different purposes. And I think what we've seen lately is as real estate started to go up and up and up, as we just saw in this last run, a lot of people would put on as much leverage or debt as they possibly could. Problem with that is you're really relying on the market and the property to go up significantly in order for you to pay all that back. Don't forget, if you're 90% financed or 100% financed, the only way for you to make money is for that property to go up in value. And then the other thing is they use really expensive financing, like 10, 12, 14% financing, which just crushes all the cash flow. Another big mistake is when they're doing the underwriting, even if they know how to do underwriting, they almost always under budget expenses. So I hear this over and over and over, and I challenge brokers and appraisers all the time. Nothing is going down, guys. Like, everything is going up. All prices are more than they were last year. We all know this. So when you're looking at some expenses for something that you're buying, please do not say you're going to cut it 20% or 10%. You need to be looking at this thing critically. Be sure to project forward with appropriate expense increases. The next one is a lot of investors don't understand ROE, or return on equity. If you're going to take $100,000 from someone or even yourself and invest it into a property and it produces $7,000 a year, that's a 7% cash on cash. That's a 7% return on equity. It's very important that whatever you're doing, that you understand what return on equity is. Because as you're trying to raise money, let's say from people that have money in a 5% T-bill, somebody can make $5,000 on $100,000. There's a perceived risk by that investor, and they're going to stay exactly where they are. Because there's more risk of taking a money out of a T-bill that's making 5% and giving it to you at, say, 6% or even 5% or 7%. because there's extra perceived risk for actually doing that when they could just sit there at 5% in a government treasury bill. The next one is most real estate investors don't understand the LP or the limited partner investor's needs. So it's very important that you understand as you're trying to raise money and communicating to investors that you find out exactly what they need. You need to meet them where they're at. Like we might have a new development, for example, that would attract one kind of investor. There would be another one that would be a value add. There would be another one that would just be what I would call a coupon clipper. So investors have different needs, and you need to understand how to communicate that to them. The next one is that investors don't have an exit plan. In other words, they just buy and they don't know why. Every single time I buy a property, I have an exit plan. Every single time in the beginning, I know the end. Every single time. I never buy a property unless I have a plan for the money and the property. There's always a plan to get the investors back out and keep the property and use the tax benefits and get cash flow, for example. Each property has a different payout, and each property is going to have a different scenario. But you need to have an exit plan each and every time. And if you can communicate that well to investors, even if it doesn't turn out exactly the way you want, you need a plan that's articulated and makes its way into the business plan itself. Right now, we are going through one of the most significant real estate events that I've seen in the last decade. If you want to find out how to turn that into a massive opportunity, just like I did in 2008, watch this video here.